Financial statements for beginners. Let's recap. The three basic financial statements are balance sheet, income statement, and cash flow statement. A balance sheet shows what the company owns and what it owes presented through assets, liabilities, and equity. An income statement shows how much the company is earning and how much it is spending by presenting it through income and expenses. The cash flow statement shows where the company's money comes from and where it is spent by grouping it into operating, investing, or financing activities. A financial statement is a package. A company cannot deliver just one or the other report. It should always come as a whole. And there is another inclusion to the financial statement package that is equally important. It is the notes to financial statements. Have you ever noticed the number references on the balance sheet or income statement? These are references to the notes to financial statements. Notes are additional disclosures that provide the details and assumptions used to prepare the figures that you see on the statements. Here are some examples of information you will find in the notes. Corporate information, which includes its legal name and structure, address, its incorporation, primary business, and other information. Group information, which details the company's subsidiaries who are included in the consolidation and its percentage of ownership over them. Accounting information, like the accounting policies and significant judgments and estimates used by the company. Accounting policies and assumptions are principles, rules, and practices that the company uses to prepare and present its financial statements. Line item accounts information, which explains how statement line items were computed and valued. This is where most of the note references you see on the statements will take you. For example, in the balance sheet, the note reference for inventories is number 8, which means details to inventories can be found in note number 8. Likewise, details to PPE are found in note number 12. Segment information, which details the company's reporting business units. Segments are how the company organizes its operations for the purpose of making decisions and evaluating its performance. But here's a slight issue with notes. Companies must follow at least the minimum requirement of disclosures, which is to provide key information so investors have a clear picture of the company's financials. But above that, it is up to management's discretion. The more notes from different companies you read, you will notice that some companies are generous with information, while some just comply with the minimum. The more insightful information we can get from the notes, the better. The notes is a very long read, but don't feel discouraged or overwhelmed. Here are tips. Start with what sparks your curiosity. If the details of PPE interest you, go directly to PPE notes. If you're more interested in the details of expenses, go to expenses notes. If you are curious about segment reporting, go directly to it. The second tip is to use materiality. If the line item on the balance sheet or income statement is small, maybe you can skip it or check it out later. But if the amount is too big compared to the total, or if there was a big year-on-year change, you might want to check the notes to find out why. Thank you for watching. If you liked this video, please like or subscribe to my page and channel. See you on the next one.